Action!
Good day everyone! In this video, we will discuss regular income tax. Regular income tax applies to all items of income except those that are subject to final tax, to capital gains tax, and under special tax regimes, like entities registered under Philippine Economic Zone Authority and Tourism Infrastructure Enterprise Zone Authority. Now, who are subject to RIT? There are two basic taxpayers subject to RIT. First is we have a natural person or an individual taxpayer. The next type is an artificial being or a juridical entity created by operation of law, otherwise known as our corporate taxpayers. Now, let's have first individual taxpayer. There are four subclassifications of an individual taxpayer. One can be a pure compensation earner or an employee. Second, self-employed individual engaged in trade or business. Third, self-employed professionals like doctors and lawyers who run their own office and offer their professional services to the public. And lastly, we have the mixed income earner or a combination of the previously mentioned three: an employee, a self-employed individual, or a self-employed professional. Now, let's go to the tax model in determining our taxable compensation income. First, we need to determine or compute for the gross compensation income and deduct non-taxable compensation, the difference of which will then be our taxable compensation income. That will be the basis in the computation of your income tax due. By then, we will be using the tax table for individual taxpayers. Now, let's have gross compensation income. How do we know if the income received forms part of the gross compensation? This type of income is any remuneration received under an employer-employee relationship. How do we know if there's an employer-employee relationship? There are four elements to remember which are present in an employer-employee relationship. One is the right to hire, or the hiring and engagement process. An employer who will be seeking for employees to work in their company will have the prerogative whether to hire or not to hire an applicant. Second is the right to wage. Once an applicant is hired and renders his service to his employer, as a matter of right, will receive a salary or a wage. Third is the right to terminate. The employer may terminate an employee based on valid grounds, like when employer is incurring serious losses and all other grounds as provided by law. And the fourth element, which is the most important element among all, is the right of control. Employer has the right to control the means and methods by which the work is to be accomplished by the employee. So those are the four elements you need to remember. Now, let's proceed to non-taxable compensation. How do we compute for this? There are only two components under non-taxable compensation. First is your mandatory contribution. What are these? So this contribution refers to your contribution that were deducted from you by your employer. The latter will remit them to a particular government institution or agency, like your contribution for SSS if you're a private employee, or GSIS if you're a government employee, contribution to Pag-ibig, PhilHealth, and union dues deducted from your salary if you're a member of a labor organization recognized in your company. Next is exempt benefits. There are four components under exempt benefits. First is excluded and or exempted as provided under the tax code and special laws. Example, retirement benefits received by an employee from SSS, GSIS, or from his employer is an exempt benefit. Next is exempt termination benefits if it is provided by your employer. Third, we have the de minimis benefits. And 13th month and other benefits is also part of NTC. And lastly, certain benefits provided to minimum wage earners are also part of NTC. Now, if you notice, exempt benefits may either exclude an excluded income or exempted income. So what's the difference between the two? When we talk of excluded income, it's actually an exempt income or an income not subject to regular tax. A list of excluded income is provided under the tax code. While exempted income are not just exempt from regular tax, but also income exempt from final tax and capital gains tax. This may be provided under our tax code or special laws. Those are just the basic difference between the two. Next is exempt under treaty or international agreements. An example to this is those employees who are non-Filipinos or non-permanent residents of the Philippines working in a foreign government institution located in the Philippines or in an international organization. Their salary or their benefits as an employee is non-taxable. Third, we also have benefits necessary to the trade or business or in the conduct of the profession of the employer. An example would be car allowance for on-call medical doctors. Another would be transportation allowance or mobile load allowance. Those that are necessary in the conduct of trade or business or in the exercise of the profession of the employer. And lastly, benefits which are provided for the convenience or advantage of the employer. Example to this is a staff house provided to employees who are residing away from or far away from the workplace or from a certain area where he is assigned to work. Still, this is considered part of our non-taxable compensation. Once you determine those type of income falling here should be deducted from your gross compensation income. And then you will arrive in your taxable compensation income. Looks like easy, right? But we'll see. We will try to apply this tax model or this formula in the succeeding video. But after this lecture, we will first focus on de minimis benefits. I know you're having a hard time memorizing the list of